How to pick winning stocks. Simple strategy. Introduction. The game of smart stock picking. The stock market has created more millionaires than almost any other institution in modern history. Yet, it has also frustrated, confused, and humbled countless investors. Most people don't lose money because the market is rigged. They lose because they invest without a clear process. Common beginner behaviors include buying whatever is trending on social media, following tips from friends or influencers, panic selling when prices fall, chasing quick profits instead of building long-term wealth. Successful investing is not about being lucky. It is about being disciplined. A helpful way to think about stock picking is to compare it to farming rather than gambling. A farmer does not scatter seeds randomly and hope for the best. Instead, they study the soil, the economy, and industry. Choose strong seeds, quality companies. Water and nurture them. Hold for the long term. And wait patiently for growth. This book gives you a simple, repeatable framework you can use again and again to select strong stocks with confidence. You do not need to be a Wall Street analyst, just curious, patient, and thoughtful. Illustration. Imagine two investors standing before a board full of stock names. Investor A throws darts and buys whatever they hit. Investor B carefully studies businesses, compares options, and invests intentionally. Over time, Investor B steadily grows wealth, while Investor A experiences stress, confusion, and inconsistent results. Chapter 1. What is a winning stock? Before you can pick winners, you must first understand what winning actually means in investing. Many beginners define a winning stock as one that rises quickly in price. But rapid price movement alone does not equal quality. Short-term spikes can come from hype, speculation, or temporary news, none of which guarantee lasting success.
A true winning stock typically has three core qualities. 1. A strong underlying business. A winning stock is built on a company that provides real value. It solves real problems, serves real customers, and generates real revenue. Companies that make essential products or services, like energy, technology, healthcare, or consumer goods, often have more stable foundations than those built purely on trends. 2. Consistent growth over time. Strong companies tend to grow gradually but steadily. You should see rising revenues over multiple years, expanding customer bases, and improving or stable profitability. A single good year does not make a winner. Consistency does. 3. A reasonable or attractive price. Even the best business can be a poor investment if you buy it at an extreme price. You want to own great companies, but you also want to buy them at fair or discounted prices whenever possible. Illustration. Buying a cheap but failing company is like purchasing a badly damaged car just because it is discounted. You may end up spending far more on repairs than the car is worth. Key lesson: focus on the business first and the stock price second. Chapter 2. The Simple 4-Step Strategy. This book is built around a clear and practical framework you can apply to any stock. Step 1. Quality. Is this a great business? You evaluate whether the company has a strong product, loyal customers, and competitive advantages. Step 2. Financials. Is it making and growing money? You examine whether revenues, profits, and cash flow are healthy and improving. Step 3. Valuation. Am I paying a reasonable price? You assess whether the stock is fairly priced, overvalued, or potentially undervalued. Step 4. Catalyst. What will drive future growth? You identify what could push the stock price higher: new products, expansion, or rising demand. These 4 steps work together like pieces of a puzzle. Missing one weakens your overall investment decision.
Chapter 3. Step 1. Assessing business quality. The moat. In investing, the strongest companies usually have what is called an economic moat, a protective advantage that makes it hard for competitors to replace them. The term comes from medieval castles surrounded by water to keep enemies out. In business, a moat protects profits and market position. 1. Brand power. Some companies are trusted, recognized, and deeply embedded in people's lives. Examples in the real world include Apple. Customers are loyal to its ecosystem. Nike. Its brand carries status and emotional appeal. Coca-Cola. The brand has global recognition built over decades. When people prefer a brand even when alternatives exist, that company has a powerful moat. 2. Unique technology or intellectual property. Certain companies dominate because their products are difficult or expensive to replicate. For instance, Google's search algorithms, Microsoft's software infrastructure, pharmaceutical companies with patented drugs. If competitors cannot easily copy what a company does, it has lasting strength. 3. Network effect. A network effect exists when a product becomes more valuable as more people use it. Examples: social media platforms like Instagram or TikTok, messaging apps like WhatsApp, payment systems like Visa or MasterCard. The more users a platform has, the harder it is for rivals to compete. 4. Cost advantage. Some companies win simply because they can operate more cheaply than others. Large retailers like Walmart benefit from massive scale, allowing them to offer lower prices while still making profits. Illustration: imagine two lemonade stands. Stand A is one of many identical stands. Stand B has the best recipe in town. Customers naturally prefer Stand B, giving it a durable advantage. Key question to ask: if a new competitor appears tomorrow, why would customers still choose this company?
Chapter 4. Step 2. Checking the financials. Follow the money. A great product or brand means little if the company cannot make money. Here are 3 simple financial signals to evaluate. 1. Revenue growth. Sales. Check whether the company's sales are increasing year after year. Steady growth suggests strong demand for its products or services. Flat or declining revenue over a long period is often a warning sign. 2. Profit growth. Some companies grow revenue but never turn a real profit. That is risky. Look for businesses where profits are positive and growing over time. 3. Cash flow. Cash flow represents the actual money entering the business after expenses. Strong, consistent cash flow allows a company to invest in growth, pay dividends, buy back shares, or survive economic downturns. Illustration: think of revenue as water flowing into a bucket and expenses as holes in the bucket. A strong company has fewer leaks and retains more water. Chapter 5. Step 3. Valuation. Don't overpay. Even an excellent company can be a bad investment if you pay too much. One common tool investors use is the price-to-earnings (PE) ratio. A very high PE often means the stock is expensive. A very low PE might mean it is cheap or that investors see problems ahead. Another simple approach is to compare today's price with the company's historical average price. If a stock is trading far above its usual range, caution is wise. Illustration: if a pair of shoes normally costs $100 but suddenly sells for $300, you would hesitate. The same logic applies to stocks. Chapter 6. Step 4. Finding a catalyst. Why will it rise? A catalyst is a clear reason why a stock's price might increase in the future. Common catalysts include launch of a new product or service, expansion into new countries or markets, industry growth, e.g. renewable energy, strong quarterly earnings reports, strategic partnerships or acquisitions. Without a catalyst, even a good company may simply move sideways for years. Illustration. A powerful car, great business, still needs fuel, catalyst to move forward. Chapter 7. Risk Management. Protect your money. No investment is risk-free. Even the best analysis can be wrong. Therefore, smart investors always manage risk. Rule 1. Invest only what you can afford to lose. Never use rent money, emergency savings, or debt for stock investing. Rule 2. Diversify. Do not put all your money into one company. Spread investments across different industries. Rule 3. Be patient. Most great stocks take years, not weeks, to deliver major returns. Illustration. A wise farmer plants in multiple fields, not just one, in case of drought or disaster. Chapter 8. A simple stock picking checklist. Before buying any stock, run through this checklist. Does this company have a strong moat? Is revenue growing consistently? Are profits increasing? Is cash flow healthy? Is the price reasonable? Is there a clear catalyst? Would I be comfortable holding this for 3 to 5 years? If you cannot confidently check most of these boxes, it is better to walk away. Chapter 9. Case Study. A hypothetical example. Brighttech. Consider a fictional company called Brighttech, which manufactures advanced solar batteries. The renewable energy industry is growing rapidly. Brighttech's revenue has increased by 15% annually for 3 years. Profits are steadily rising. The company owns a key patent that competitors cannot copy. It recently secured a major contract with a national utility provider.
Applying our framework. Quality? Strong, clear moat through technology. Financials? Positive and growing. Valuation? Fair relative to industry peers. Catalyst? Major new contract and industry demand. This is the type of company that fits our definition of a winning stock. Chapter 10. Common mistakes beginners make. 1. Chasing hot stocks. Buying only what is trending often leads to losses. 2. Selling too quickly. Many investors sell after small drops, missing long-term gains. 3. Ignoring financials. Some buy based on hype without checking profits or cash flow. 4. Investing without a plan. Successful investors have clear rules and stick to them. 5. Letting emotions decide. Fear and greed are the biggest enemies of good investing. Illustration. Many people panic and sell at the bottom, only to regret it when prices recover. Conclusion. Build wealth one smart pick at a time. Picking winning stocks is not about predicting the future with perfect accuracy. It is about following a clear process, making informed decisions, and staying patient. If you consistently apply the 4-step strategy, quality, financials, valuation, and catalyst, you give yourself a strong chance of outperforming the market over time. Final takeaways. Great stocks come from great businesses. Always analyze before you buy. Manage risk and diversify. Think long-term, not short-term. Invest wisely, stay disciplined, and let time do the heavy lifting.